of England live stream, and what I'm going to do is just summarize what the Bank of England did today and why, and then we'll launch some Q&A. And so that's what the plan is. But let's just start with what they did, which was nothing. This was what markets expected, that they'd do nothing, and they certainly delivered. And but what's interesting about these rate decisions is the reasons behind it. And in the UK at the moment, we're in quite a different situation to the Fed, which I covered yesterday. So the Fed, they've got a very strong economy and inflation is sticky. In the UK, we've got a very weak economy and we've got sticky inflation. And it's services inflation, which is seeming to be quite sticky and very difficult to get rid of. Wage growth is still quite strong in the UK, and that feeds through to service inflation. So service inflation around 5%, and of course services is a big part of the UK economy. So it is a problem, and it is looking like there's a kind of upside risk to UK inflation and an uptick in UK inflation that we're seeing at the moment. And that's certainly got the Bank of England worried. Similarly, in the US, we've also seen an uptick in inflation. But the difficulty faced by the Bank of England is that they have a weak economy at the same time. So if they keep rates high for a long period of time, they could quash any kind of growth that we see in the UK. Because at the moment, we're just kind of stagnant, the economy, which is exactly not what the current government wants to see, or any government for that matter, or any member of the population for that matter. So overall, fine balancing act for the Bank of England, and it wasn't unanimous, so that was interesting as well for this rate decision. It was 6-3, because there are 9 members of the Monetary Policy Committee that makes the decisions. And if we look at the overall vote, and you can see that it's to keep rates at 4.75, and previously there was more unanimity about the decision. So it's clearly become more of a difficult choice whether, if they keep rates at the current level, it's going to squash any future growth. So weaker growth was definitely part of that picture. But we can see that whereas the US has cut interest rates from its peak by 1 whole percentage point, in the UK we've only cut it by 0.5 percentage points. And if anything, I think we should be cutting it more because of the weak growth situation in the UK. But yeah, it is a worry that inflation is still running pretty hot for services. In terms of the market impact of those of their monetary policy decision, you can see that there was a very brief increase in the value of this UK gilt tracker. So, yields fell very briefly, the prices increased, but it was a very short-term change. So not a lot of change in the gilt market. The big change, I guess, was yesterday when the Fed decided to cut their policy rate by 25 basis points. So this is the value of sterling versus the dollar. So sterling weakened, and over the course of today, what we saw was no change decision by the Bank of England, and that weakened sterling again. So I think it's pretty interesting that we're seeing this divergence now between what the Fed's doing and what the Bank of England's doing. But both of them made it very clear that they think that inflation is going to be stickier for longer. The Fed raised its dot plots yesterday, which is its monetary policy expectations based on what the FOMC members think. And that didn't sit well with the equity market, which sold off very strongly. And it looks like the Bank of England is also looking like it's going to be keeping rates higher for longer now. So if we look at market expectations, they're expecting 2 rate cuts for the UK over the course of 2025. And that's exactly what they're expecting for the US as well. So we've gone from expectations of pretty rapid rate cuts over the course of this year, both in the UK and US, to a situation where we get very cautious rate cuts over the course of 2025. which isn't good news if you're a borrower, but it's good news if you're a saver, particularly in money market funds where the policy rate pretty much feeds into the rate of return that you receive for your money market fund. So what did Andrew Bailey say? He said, we think a gradual approach to future interest rate cuts remains right, but with a heightened uncertainty in the economy, and we'll talk about that in a sec, we can't commit to when or by how much we will cut rates in the coming year. So essentially pretty similar to what Powell was saying yesterday, which is greater uncertainty. What's causing the greater uncertainty? Well, it's basically the Trump government and what he's going to do when he gets into office. Is he going to impose tariffs on the UK? If he does, how large will those tariffs be? Will the UK have to choose its trade partners? If it chooses to export to the US, will it not be able to export to Europe? Or, what will the deal be that we come up with? So that's the source of uncertainty, and that'll affect inflation. It'll affect growth, and we just don't know what that policy will be. So that's one of the sources of uncertainty. I think the other one is about how sticky inflation is. So, how much of this is services inflation going to fall over the course of the year in response to this very tight monetary policy, which we've still got in the UK, because it is taking a long time to subside. So let's have a quick look at that service inflation that I was talking about. So the dark line that you can see here is services. Notice how that's been really slow to fall, and it's still at roughly 5%. And it peaked at what? About 7.5, something like 7%. And it's not fallen by much at all. Whereas if you look at goods inflation, it actually went into deflation for several months over the course of 2024. Now it's gone back into positive territory. But it's interesting that services inflation is just so sticky. But we saw the same thing in the United States. So that is worrying, and it's worrying for the Bank of England. And if we look at what led the upward contributions to the annual CPI print that we just saw, you can see that transport, which is energy basically, fed into that. Recreation and culture, clothing and footwear, fairly broad-based. Only one component was falling, and that was restaurants and hotels. That was the only significant fall contribution, pulling downwards on the rate of CPI inflation. So that's why it ticked upwards. Almost all of the components were pushing in an upward direction. So that's not what the Bank of England wants to see at all. And if we compare us with other developed economies, unfortunately, we're back at the top of the pack when it comes to CPI inflation. So the UK, 2.6, Germany, 2.4, US, 2.3 if you use the hiccup measure, and France, 1.7. So again, not where we want to be. And if we look at the minutes, there are three scenarios they look at, and these are how they now think about monetary policy. And it looks like what they're moving towards is more of scenario 3, which is going to require higher rates for longer, which I call hit me with your policy stick, where there are structural shifts in the economy, that means long-term changes, where people simply got used to higher wage growth, and it's going to take really restrictive policy to change that mindset. Not just people, but also companies have got used to having to adjust prices upwards to adjust for higher input costs for their business. So it'll take a long period of high rates in order to squash that out of the system. Whereas previously they were talking about scenario 2 being the central case. I think, based on what they've said, they are kind of shifting towards scenario 3. And that means higher rates for longer. Good news for if you're a saver, though, as I am. So just to summarise the monetary policy, just to summarise the minutes, I think there are 3 components to it. You don't need to see that. I can just use that as a guide. But the idea is that rates were expected to be around 3.75 to 4% in 3 years' time, compared with 2% in the euro area. So this is based on market expectations of what's going to happen to interest rates. So US and UK expected to stay fairly high, so 3.75 to 4% in 3 years' time, which is pretty high compared to what we're used to, compared with 2% in the euro area. So market expectations are clearly quite hawkish. They're expecting higher rates. Growth is just looking awful. Bank staff now expect zero GDP growth in 2024 Q4, so a flat economy. And that's weaker than the 0.3, which was weak anyway, that they'd been expecting in November. And that was based on business surveys and available official data. And then finally, wage growth, which I mentioned is still pretty brisk. The average weekly earnings wage growth was around 4.8%. That's still very high. So, that's not really consistent with 2% inflation, which is the Bank of England's target, and that's pretty worrying. Now, if you have got a mortgage, then this has a big implication for you, because what we've seen is that mortgage rates have not really fallen at all. Many people were pretending, or maybe really thought, that it was a done deal, that interest rates would be falling, but that has not been the case at all. And remember that this is priced off the swap curve, it's not bank rate. And the swap curve is priced based on expectations of what's going to happen to the Bank of England's policy rate. And now that the Bank of England sounds more hawkish, it'll keep rates higher for longer, the swap curve is kind of reflecting that, as are mortgage rates. So they have fallen a bit, but not a huge amount from their peak over the course of the last year. So if you are coming off a fix, I think it's not a done deal that waiting is going to necessarily help, that you're going to get a lower rate if you wait 6 months, a year from now. It may be that simply doesn't happen because of inflation. So, I think that's kind of my summary of it. Weak growth in the UK, a very cautious Bank of England and Fed, a lot of uncertainty coming down the road in terms of inflation and what's going to happen to tariffs based on our trade with the US, how we can do our own trade, given that we're quite a small country now that we're not part of the EU and we have less clout, and we're effectively just going to have to do what the US kind of insists that we do. So that's the problem, I think. Uncertainty, weak growth, and a Bank of England which seems to be saying that they're going to have to keep rates higher for longer, and a Fed doing the same thing. So now let's switch to your questions, and before we do that, I'm going to summon my dog, and then you can ask some questions. So please do ask. If you super chat, we'll push you to the front of the queue, and if you're one of our supporters on YouTube also, we'll push you to the front of the queue for the questions. Any kind of investing question is fine. Now, somebody yesterday said, Ted, they were very impolite. They said, don't do the dog tricks. Well, I'm afraid that's impossible. Oh, he's refusing. Over here. You see, you're grabbing my leg, mate. Very good. One more. And we've got ribs for dinner, so I'm going to rush this live stream. Here we go. Very good. Well done. Now he'll go downstairs for biltong. Yeah, please do like, please do subscribe if you haven't already, and if you do have any questions, please do shoot. And if you do a super chat, obviously it helps us, so I'd appreciate it. I think you're going downstairs for biltong now, Ted. There you go. Laura's got biltong. Off you go. I'm quite excited. I bought my son biltong cake for his birthday. So it was like 1.5 kilograms of biltong. Fortunately, he loves it. And he can share it out with the rest of the family, I'm hoping, for Christmas. That's very exciting. Anyway, hopefully Ted will get some of that as well. Yeah, please do super chat, or if you are one of our supporters on YouTube as well, you get pushed to the front of the queue. So let's see what we've got for questions. Nick Anderson says Chase wasn't happy with the vote as they sent email saying savings will be 1.5% below rate instead of 1.25. Okay, so maybe they're cutting rates already in anticipation of a cut which didn't happen. That's not so good, is it? Night Train 123 says, how much is this attributable to the public sector pay rises? I think that's part of the story. There's, how inflationary are those? Well, it's hard to say. I think the Bank of England as well isn't absolutely sure. Let's see if they say anything about it in the... no, they don't. They don't say anything about it in the minutes, but I think that's certainly a factor. I think also what's interesting is if you look at the national insurance contributions, which come from employers, which are now having to be paid by employers, and that was part of the budget that we saw in autumn, then people have been saying that that's going to slow down wage growth. So, maybe there'll be a countervailing factor there. But I'm not convinced that public sector wage growth is really going to make a huge difference here. Because, if you think about those people who are on public sector pay, certainly for some of them, if you're a doctor, we have seen wage growth there, and they are pretty well paid anyway. So in terms of their consumption, perhaps there's going to be a slight increase in consumption. Maybe that'll be inflationary. But overall, it's private sector wage growth, which people tend to focus on. And that is pretty brisk. So it's a combination of that and also public sector wage growth, I guess. Although public sector, I'm guessing, is slightly smaller on average, the wages there. Because a lot of teachers, which aren't particularly well paid, a lot of nurses, which aren't very well paid. Whereas the private sector, I think on average, you get higher wages. I think it's more the private sector, which is the worry. And there we are seeing fairly rapid wage growth. Average weekly earnings is increasing by, I think it was 4.6% per year. So not really compatible with 2% inflation. What's your take on the mini crash of the US stock market? Well, yeah, it's pretty clear that growth stocks in the US hate higher interest rates. Growth is particularly sensitive as a factor to interest rates. And so Bitcoin sold off a lot. The Nasdaq sold off a lot. So did the S&P. There has been a bounce back today, it's got to be said. So if we have a look at the US markets today, why don't we get SPY? That's usually a good barometer. So the S&P tracker, SPY, the Spiders Trust ETF. Let's zoom in on that. Yeah, not great. Okay. I thought there had been a bit of a recovery, but it doesn't look like it. So this is the S&P tracker. So let's just look at the size of that size of that fall. Yeah, so it's chunky, 2.93. There may be a little bit more. Yeah, about 3% fall. So pretty big compared to what we've seen over the last very long period. That's a sizable fall compared to what we used to. Markets have just been grinding up and up on the news that Trump has been elected. But people have been referring to Powell as the Grinch that stole Christmas. But look, it's not a huge fall, not yet anyway. But the Nasdaq, obviously, bigger fall. So the reason behind it, higher interest rates, not good for... Okay, they cut interest rate, they cut the policy rate. Okay, maybe that's confusion. The Federal Reserve cut the interest rate by 0.25%. But if you look at their forward guidance, if you look at the dot plots, those are all shifted upwards, because what they're saying now is that the rate at which they cut is going to be slowed down because of worries about inflation being stickier than expected. So now they think it's roughly equal risks on either side. of cutting too quickly and inflation flaring up again, or keeping rates restrictive and crushing US growth. And clearly markets didn't like that upward revision of the dot plots. That's what really spooked markets, I think. So it was a hawkish cut is what people call it. Hawkish just means higher rates, right? So a hawkish cut is kind of like an oxymoron, but that's what it means. The forward guidance was up, but the actual cut was 0.25%. And they also kind of said, in fact, Powell actually said that they'd be more cautious with the future cuts because of uncertainty about inflation, which basically means tariffs. There were lots of questions about will he look through the tariff-related inflation or not. So that was the dialogue yesterday. But it affects the UK as well, so I think that's important to understand too. Tancred Hortville says, his secondary question, I don't understand why there was any expectation for rates to fall. Why? I never expected it. Yeah, well, certainly for the Bank of England, there wasn't an expectation. People thought they wouldn't cut today, and they didn't. So no surprises in the UK. But if we go back just to October, they were expecting big cuts for interest rates. And the reason for that was inflation was falling very sharply at that point. The rate of inflation was falling very sharply. There was a lot of disinflation. So people just thought, oh, fine, we've turned the corner. We're going to get back to 2%. Rates too restrictive. Let's just cut. But then, of course, Trump won the election. And a lot of his policies, on the face of it, seem inflationary. We don't know what they're going to be. But the ones which we've heard about on the campaign trail are very inflationary. Things like restricting immigration, deporting millions of workers. Usually that has, by restricting the size of the labour force, you have to substitute that labour with more expensive labour, and that pushes up prices. And then we've also got tariffs, which push up inflation over a 12-month period. And of course, we're talking about stimulating the economy, so that would also be inflationary. And cutting taxes, inflationary. So almost all of his policies are inflationary, and that's pretty worrying. So I think that's why people expected, that's why we suddenly got a turnaround on rate expectations. We've gone from a world where inflation was falling to where we've got this inflationary set of policies coming out of the Federal Reserve, out of the Trump administration, potentially. But we'll just have to see what the actual policies are. We don't know yet. Or what's going to be done to mitigate the more extreme policies which we've heard about so far. Hopefully sanity will prevail and it won't be too bad. Sarath Babu Arav Bhumi says, wish you both a joyful Christmas and a great start to 2025. Thank you very much, Sarath. That's really kind of you. Same to you and to everyone who's watching. Happy Christmas. If you celebrate Christmas, happy Hanukkah if you are Jewish, or however you celebrate, we wish you a nice festive season. I think that's the correct terminology. Just wanted to say a massive thank you for all the guidance you've given me over the year through your videos. I'm so grateful for all that you do. That's really kind. Thank you very much. In fact, I think I just heard the Prosecco popping downstairs, so Laura's celebrating early. So let's switch to two of your super chats, because we have got two now. Thank you for that. Parpignon says, thank you, Ramin. What's your view on Trump's banks deregulation? Is the UK going to follow? Do these changes mean banks will take off and inevitably bust again? Good point. I think when you get deregulation, there's always the risk that banks suddenly think, oh, fine, I'm going to do lots of more risky things in order to generate more profit, and inevitably you get some kind of a crisis down the road. Usually it takes about 12 months, 2 years, but they happen. So Silicon Valley Bank, for example, some people are saying that that was a result of deregulation by Trump in his previous term. And that allowed Silicon Valley Bank to take more risk, and that led to the crunch when it had huge capital flight and essentially a social media driven run on the bank based on worries about its treasury holdings. So yeah, I think deregulation, the worry is always that, 2 years down the line, 1 year down the line, 3 years down the line, you're going to get some kind of crisis because a bank has been careless, because it now can be careless, because regulation's not reining it back in. Because there's always a temptation to increase risk, boost your share price, take your stock options, and then head off into the sunset and leave destruction in your wake. That's always the risk with banking. And regulation is there to stop that kind of cowboy behaviour. And if regulation gets dialed back, that is a worry. So yeah, I wouldn't be surprised if we start to see problems down the road. But is it good for the banking sector right now? Yeah, I think it definitely is. If you look at banking sector valuations at the moment, they're still pretty low. Sector PE. There we go. Yeah. Yeah, here we go. So this is sector PE from Finviz, which is great, by the way. This is forward PE, so I'll sort by forward PE, and you can see that financials, number 3 on the list, are actually looking pretty cheap still. 15.8 times forward earnings. You compare that with tech, that's 27 times. So still pretty cheap. And those have done pretty well. And when we did have the Silicon Valley Bank crisis, I bought a US banking sector tracker. And it took a long time for it to turn around, but it did. And then it really started to power up. Maybe I sold it too soon. I think I probably did. Should have probably held on to it. But, I made about 30% on that, so I was happy. 20, 30, I can't remember. But it was a pretty good return, and I thought, fine. It's probably not going to go much higher. But yeah, I think that's going to be good for financials. A lot of it is priced in now. I wonder if we've got the price for financials. No. Okay. I was hoping there was going to be a financials ETF I could use as an example, but I don't think there is. But yeah, that's the... it is going to be a bust, but maybe I should buy that thing again. I think that could be good. I saw it was quite funny. Someone I follow on Blue Sky actually has a graft or a grift basket of all of the stocks and sectors which are going to benefit from Trump's policies, which is kind of interesting. It's difficult to gauge, I think. A lot of it's priced already, but as time goes on, we'll see certain sectors which definitely benefit from these big changes in fiscal policy and monetary policy. Okay, so I hope that answers your question, Parpignon. The next question, super chat, thank you, from LC is, hi there, about 5 years until I might be taking from my SIPP and stocks and shares ISA. So you've built up money, you're going to be withdrawing in about 5 years. Should I add more to my ISA or SIPP? Self-employed, so no longer contribution. So no employer contribution any longer. Okay. Well, yeah, the good thing about a SIPP is if you're self-employed, it means you're effectively getting less wages once you subtract the pension contribution. So if you put more into the pension, effectively it reduces your income. So you pay less taxes up front, which is good. And of course, while it's in the SIPP, you're not going to have to pay capital gains or income taxes. It's only when you withdraw the money in drawdown that you have to pay income tax on that withdrawal. So that's the benefit of the SIPP. With the ISA, and of course the SIPP now is no longer useful for inheritance. So it used to be that you wouldn't have to pay inheritance tax at all on your SIPP if you hadn't entered drawdown. Well, now you do, right? It just forms part of your estate. So the inheritance tax consideration isn't there anymore, but it's still very tax efficient to save for yourself for your own retirement. And the ISA, of course, is more flexible because in retirement, any money you take out of your ISA, you don't have to pay tax on at all because it's treated like savings because it is savings. So you can use that to top up your income, and it's very flexible. You can carry on putting 20k in if you have excess cash. Whereas with the pension, once you enter drawdown, it's restricted what you can put into it. Plus, your ISA, I think, is just much more flexible. Some of flexible ISAs are actually called flexible ISAs because you can actually put money in and take it out during the course of the year. And as long as the total amount that goes in over the tax year is less than 20k, you can put money in and out repeatedly. Whereas for a regular ISA, which isn't flexible, once money goes in, it just ratchets up your allowance for that year. So let's say it's a flexible ISA. You could put 10k in, or let's say you put 20k in at the beginning of the year, your full allowance. But then later on in the year, you think, oh, I need 10k for this expenditure which I've got. So you take 10k out, but then you spend your money, you make some more money, and you can put that 10k back in. Whereas with a non-flexible ISA, you couldn't do that. You couldn't have taken it out. Once you take it out, then it's just treated as a withdrawal and you can't put it back in without going over your 20k limit. So certainly a flexible ISA is very flexible, and I think they're a great savings tool and incredibly generous. You never pay capital gains tax or income tax on that ever again. You do pay inheritance tax, of course, but that's now in line with the SIPP. It just forms part of your estate. So which is preferable? I mean, it might be that if you put money into a SIPP, you could actually reduce your tax that you pay. If you're close to a tax boundary, maybe that'll be enough to kind of push a fairly chunky amount below the tax threshold, so that could make a big difference. I can't tell you without working out your circumstances, but those would be the considerations. Do you want the flexibility of an ISA? Do you want to tie up money in your SIPP, which you can't touch till you're 55? But it sounds like you're only 5 years away from that anyway. But yeah, but if it comes to inheritance tax, that's not really a consideration anymore. It's really about flexibility, I think. And also being able to top up your income. I think I'm kind of veering towards the ISAs more at the moment because they're just more flexible. You can carry on putting money in, even in retirement, and when you take it out, you don't have to pay income tax on it. Next question is from James CS, a super chat. Thank you, James. He says, just to thank you for the education. Well, that's very kind. Thank you very much. So how are we doing? We'll answer one more question. One more. And then we'll kind of wrap up, I think. Because we've had 2 of these on the trot, night after night. Okay. Next question. I'm wondering if Bailey is on Ozempic. He's looking rather svelte. Yeah, I've noticed that too, actually. He does look quite thin now. I noticed that when I was looking at one of the pictures. Or maybe he's just kind of not going to Greg's anymore. That might be the reason. It might just be discipline. We'll answer one more question. What's the best hedge against inflation? That's a good one. I'd say equity. Over the long term, equity is probably the best way to fight inflation. If you look back over history, you'll see that if you want to beat inflation, equity's done that fairly consistently by about 5% per year. And that's very unusual if you look at different asset classes to find something which has beaten inflation by quite so much. Bonds by about 4% less. Money market funds just about keep in line with inflation a little bit more historically. So I think that's probably the best inflation hedge if you are looking over the long term. Shorter term, then you can use more kind of dodgy hedges, which are things like If you think the source of inflation is going to be energy prices, you could buy exposure to energy, either with a basket of energy producing companies, so energy producers like Shell, for example, Exxon, and others, or you can buy direct exposure with a commodity ETC, exchange traded commodity fund. So that's another way to do it. If the source of inflation is indeed commodities, which it often is, it is usually the case that it's commodities behind the spike. But if it's supply chain disruption, clearly that's not going to work. If that's what's causing the high inflation, if it's rapid wage growth, then that's not going to act as a hedge. So it really depends on what the source of inflation is. But longer term, yeah, equity is probably the best hedge for inflation. The hedge breaks down if inflation's super high. So if it exceeds about 5, 6, 7% per year, then what you usually see is that equities derate. We didn't see it this time, but usually that's what happens. And they don't hold up well because they're also affected, of course, companies. Their margins are affected by high inflation. It increases their input costs and they can't carry on increasing their prices to match their input costs because people can't afford it. Unless they have a monopoly, of course. So, yeah, I'd say, gold is an awful inflation hedge. I'd probably avoid that. It keeps track with inflation, but it doesn't beat it by much long term. Stocks are probably the best one. Property, remember, in the UK has just matched inflation for the last 20 years. So that's a very poor inflation hedge. So, I wouldn't use that. So let's end there. I think that's probably enough. And thank you for your time tonight. Don't forget, if you do like us, then like this video, subscribe to our channel. If you want to join our community, just go to pensioncraft.com/membership. You can now follow us on Blue Sky. We've got a starter pack. We've got a financial news feed, which you can also use. You'll see it. I posted it yesterday. So look us up on Blue Sky. We're still on Twitter as well, X. Do join our community. And of course, we have a free weekly market roundup. You can sign up for that too. Just go to our website, pensioncraft.com/newsletter. And we try to make a kind of jokey weekly summary of what's going on in economics, but also in markets. And we try to get as many jokes into it as we possibly can. So it's rich with puns. But it is also helpful, I think, for understanding what's going on in markets. So do please have a go signing up for that. Anyway, thank you all for joining us. And we will be doing this again, of course, next time the Fed and the Bank of England change their monetary policy. So stay tuned for that. And thank you for your time. And good luck with your portfolios.